All right, the 5-year Treasury is at 3.95 to start the week. The 10-year Treasury is at 3.99. And we got another labor market estimate of 216,000 jobs last Friday. The reason why I'm calling it an estimate is because 12 of the last 13 reports were revised down. October was revised down to 105,000 from 150,000. Now, the devil is in the details, and that's not normally what the media likes to report. For example, of the whopping 216,000 jobs created, 25% of them were government jobs. I mean, we're not really looking at government jobs as a strong job market indicator. They're going to hire regardless of the economy. So not only that, unemployment remains unchanged at 3.7%. Now, I'm not saying that the job market's weak. I'm just saying it's not as resilient as the media makes it out to be. So let's look at a few other key details of December's jobs reports. The number of people employed part-time for economic reasons came in at 4.2 million. That's 333,000 more over the year, or higher over the year. The number of people not in the labor force that currently want a job was up 514,000 over the year. By the way, these points are taken from the actual labor report itself. So if the report isn't painting a picture of the most resilient job market in history, why is the media? In fact, the ISM Services Employment Index actually had a huge drop-off on Friday. It showed the third lowest print on record, aside from the great financial crisis and COVID. It's time to just wait a few months for the labor report to be revised down before making any judgments. And the way I see it, the market's okay. The labor market is okay, but it's not great. And we're headed closer to the number the Fed's looking for, which is 100,000. I mean, we were pretty much there in October. So that is the number that the Fed's been looking for. But that being said, I don't think the Fed is looking at that labor market report as an indicator of when they should start cutting rates. There was a point when they were, but I think there have been enough other indicators to show that we do need to drop rates. There's been a lot of other data that's showing that we're trending in the right direction. So on the rate front, the 5-year and the 10-year Treasury spiked back over 4% late last week after the strong jobs report. And overall, I would say that we're headed for lower rates. I will say that I feel we're going to see Treasuries to continue to trend lower. As I've said over time, over the last several months, it's going to be a bumpy ride. So it's not going to be straight down, never is. So we're going to have some up days and some down days. But overall, I see that we're headed lower. So Treasuries are just a touch under 4 today. And interestingly, Friday's jobs report didn't have a huge impact on the market's expectation for cuts this year. The market is predicting a 62% chance of a cut in March, as opposed to the 70% before the report came out. So it's down just 8%, and we're going to have some news coming out this week that might sway that even more. I still think March is a little early for a rate cut. More likely, we'll see our first cut in June. Powell's pivot at the December FOMC meeting is an indicator that he's more concerned about the economy. So on the lending front, I'm seeing lenders overall continuing to be conservative, and still most haven't dropped rates as much as Treasuries have dropped. For example, Treasuries are definitely 100 basis points down. Most of our lenders have dropped rates 50 to 75 basis points. So if I were just using a standard 200 basis points over the corresponding Treasury, our rates should start with a 5. But I think that there's a myriad of factors going on. Lenders still have a lot of money out at between the high 2s and let's say 4%. So they're looking for some of those to pay off. There's these impending liquidity requirements that they're going to have. That's looming. And then there's still just a lot of uncertainty in the market. So as we get some certainty, I do feel that we'll start to see those spreads drop a little bit as well. So some of our owner-user lenders actually do have rates that start with a 5. So that's good news. We haven't seen it yet for multifamily, unless maybe you're going to an agency lender or, you're doing agency financing or something like that. That's still kind of like a maybe you would see rates in the 5s. But for multifamily, I am seeing the best rates are for well-located, lower leverage deals. And like I said, lenders are still continuing to be a little bit conservative. So it's all about mitigating factors. I talk about this a lot when I'm talking with clients too about programs. So for example, if you have an apartment building or a property that you're looking to finance that's in a little bit of an outerlying area. It's maybe in a C or a D neighborhood. It's recently just been leased, all of the units. It's gone through like a renovation or something. It's got a bunch of ADUs added. Those are all reasons why a lender may choose to pass on your deal or price it a little bit higher than a strong, low leverage, well-located deal. So it's really just property to property, and it's highly dependent on not only the property, but also the borrower. Like a lot of people, especially people who are just trying to get in apartments, they go, well, it doesn't matter about me, right? It's all about the property. That's like kind of true, but not really. I mean, we do care about the person. We obviously need decent credit, and we are looking and good income and all of that. And lenders are looking at that more than ever. So that does matter. So strength of the borrower and also like the attributes of the property. How strong is the property? So anywho, let's wrap it up with what is happening this week. Now, the most important piece of news, there's other news coming out, but the most important thing right now is CPI, which is forecasted to fall from 4% to 3.8%. That would be the first sub-4 report since May 2021. Now, the monthly number is forecasted for 0.3%, which would be 3.6% annualized. So the 20-year average is 2.4%. So we do have work to do, but we've made a lot of progress without going into recession or spiking unemployment. So that is all really good news. It may soon change. I guess the coming months remain to be seen. But as of now, we've made huge progress on inflation. We certainly hope that the Fed has not waited too long to cut like he normally does, historically, waiting too long to act. So hopefully we'll see whether or not we're in a recession or if unemployment spikes. I have a feeling that both will happen, but they won't be anything near the great financial crisis. So that's just my little prediction. And that is the news coming out this week. So watch out for that CPI reading, and I will see you all next week.